Are you looking to become a more successful investor? Today, we're going to cover the 7 key habits that distinguish highly effective investors from the rest. Implementing these habits can help you make smarter investment decisions, manage risk better, and ultimately grow your wealth over time. Let's dive in. Habit 1. Have a long-term mindset. The first habit is to cultivate a long-term mindset when it comes to investing. Too many investors get caught up in short-term market fluctuations and make rash decisions based on fleeting emotions like fear or greed. Highly effective investors, on the other hand, realize that stock markets can be volatile in the short run but tend to grow over many years and decades. They take a patient, disciplined approach focused on their long-term goals rather than getting worked up over daily price movements. Investing for the long haul allows you to ride out the market's ups and downs while giving your investments time to compound returns year after year. Habit 2. Diversify broadly. The old saying is, "Don't put all your eggs in one basket," and diversification is crucial for managing risk and achieving consistent returns. Effective investors build diversified portfolios by spreading their investments across various asset classes like stocks, bonds, real estate, commodities, etc. Within each asset class, they also diversify across different sectors, geographies, company sizes and more. This diversification helps reduce overall portfolio volatility since different investments will zig while others zag. While diversification doesn't always maximize returns in any given year, it does tend to smooth out returns over longer periods. By being broadly diversified, effective investors can better withstand temporary declines while giving themselves exposure to different sources of potential growth. Habit 3. Minimize costs. The lower your investment costs, the more you get to keep of your hard-earned returns. That's why highly effective investors are laser-focused on minimizing all the fees and expenses related to their investments. This includes favoring low-cost index funds and ETFs over higher-cost actively managed funds. It also means being tax-efficient by maximizing contributions to tax-advantaged accounts like 401(k)s and IRAs. Costly practices like frequently trading stocks or working with expensive brokers or advisors should also be avoided when possible. By cutting out wasteful fees and taxes, more of an investment's returns go straight into the investor's pocket rather than being siphoned off by middlemen. Reducing costs by just 1% per year can make a dramatic difference in overall returns compounded over decades. Habit 4. Stay disciplined. Investing wisely requires incredible discipline. The discipline to stick to your long-term plan regardless of what the markets are doing, the discipline to take emotions out of the equation when making buy and sell decisions, the discipline to rebalance your portfolio periodically to maintain your desired asset allocation, the discipline to keep investing regularly through all market conditions rather than trying to time the market. Highly effective investors are grounded in their investment philosophy and process. They don't let greed or fear knock them off course. The discipline allows them to take advantage of market dislocations when others are panicking. It's this discipline that separates investors who build serious wealth over a lifetime from those who struggle or underperform. Cultivating discipline may be one of the most challenging yet vital habits of successful investors. Habit 5. Continuous learning. The most effective investors are lifelong students always working to improve their knowledge and mastery of investing. They read extensively about different investing strategies, study market trends and economic conditions, and continuously work to enhance their analytical skills. They aren't afraid to admit what they don't know and are endlessly curious to learn more. As the investing landscape evolves with new products, technologies and regulations, effective investors adapt by updating their approach instead of stubbornly sticking to outdated methods. They also learn from their own successes and mistakes over time, constantly refining their process. This dedication to continuous learning allows them to stay ahead of the curve and make well-informed, cutting-edge investment decisions. Habit 6. Manage risk prudently. While most investors focus solely on generating returns, highly effective investors also prioritize managing risk in their portfolios. They understand that taking excessive risk can lead to devastating losses that are difficult to recover from. so they employ strategies to mitigate and control risk exposure. This includes practices like maintaining an emergency fund, using asset allocation to balance potential risks and returns, considering the role of protective investment options like hedge funds or market insurance, avoiding overconcentration in any single investment, and doing ample research and due diligence before making major investment commitments. Effective investors strike a pragmatic balance between pursuing growth while still safeguarding their capital through prudent risk management. Habit 7. Stay humble. The final habit of highly effective investors is to remain humble despite their success. They understand that investing is an endlessly complex endeavor where even the most skilled can make flawed decisions or have their convictions upended by unpredictable, black swan events. So while they have confidence in their process and approach, they avoid overconfidence and hubris character flaws that have brought down many an investor. Truly effective investors are open to admitting their mistakes, changing course when warranted, and realizing how much they still have to learn. Their humility motivates them to continue improving their craft while maintaining a crucial margin of safety in their portfolio construction. They don't delude themselves into thinking they can perfectly time markets, forecast future outcomes, or avoid all risks. Instead, highly effective investors humbly accept the limitations of their abilities while doing their utmost to make optimal, risk-aware decisions within that reality. Conclusion. There you have it, the 7 key habits of highly effective investors. Long-term mindset, broad diversification, cost minimization, discipline, continuous learning, prudent risk management, and humility. It's no easy feat to consistently implement all these habits. But making the effort to cultivate them can put you on the path towards achieving your long-term investing goals and reaching new heights of financial success. Which of these habits will you focus on improving first?